This is a lesson on preparing a statement of cash flows, number 2, and we're going to focus on a company called Slip-On-In Sandals. You can find the activity for Slip-On-In Sandals on the link to where this video is, or on Blackboard on the activity page. Okay, Slip-On-In Sandals. Slip-On-In Sandals. So what you see when you print out the activity, you'll see an income statement and you'll see the balance sheet. But also you'll see a box to the right with some data that we're going to have to take into account as we prepare the statement of cash flow. So we're going to focus on making some of that data relevant to us. So first of all, the first fact, is that dividends were paid. Now, it doesn't tell you how much dividends were paid, but we can figure that out. Okay, so we always know that if we have retained earnings, and we can look at the retained earnings account, we know that the beginning balance in our retained earnings account was $5,000, and we know that the ending balance in the retained earnings account was $210. So I've set that up in a T account. And what else do we know? Well, we know we always have additions to retained earnings for dividends. And when I say dividend, for net income. So net income, remember the closing entry for net income? If to make it simple, we would we debit revenues, right? And then we credit retained earnings. And likewise with expenses, we debit the retained earnings and we credit the revenues or the expenses. So it closes those accounts out. And so what we can do is we can look at the revenues minus the expenses, and that will generally be the amount of the adjustment to the retained earnings. And the difference between the revenues and the expenses is net income. All right. So our net income in the case of Slip-On-In Sandals is $1,410. So everything else being equal at this point, we would expect retained earnings to have a balance of $6,410. Well, we can see that the ending balance is $210. So a dividend must have been paid, and that dividend looks like it was about $6,200 because a debit into the retained earnings account of $6,200. So let me do the journal entry for that. So it would be retained earnings would be debited for $6,200, and we could just call it cash because that would be the amount paid as the dividend. That makes this account balance. So one of the things we need to think about when we're doing this is if we're given a hint that dividends are paid, we can always go back in and calculate them based on the evidence given. Or even if you're not told that dividends are paid, one of the things you may want to do is look at the change in the retained earnings account, and if that change does not equal just net income, right? If it doesn't equal just net income, then dividends must have been paid. Okay, so that's the first piece of information, and I'm going to put this on this page right here. So the first piece of information I need is that dividends were paid of $6,200. And on our statement of cash flows, this will go into the financing section because this is basically a payment to shareholders, and which is part of the financing transactions. Interestingly enough, though, there's not a parallel here, and that parallel would be that interest payments would also be part of the financing section, and they aren't. They are part of operations. So we have a little bit of a disconnect in that, but it's just what it is. All right. Let's go then. Let's look at any other adjustments we may need to make. Depreciation expense is included in cost of goods sold. Okay. Well, we know that our cost of goods sold is $2,790. And I want to subtract out of there the depreciation expense. So remember, we always are going to add back depreciation expense as a non-cash expense. So I'm actually doing two things here at once. We're going to have to find back the depreciation expense we're going to have to add back for the indirect method. But for the direct method, we're going to need to know how much to adjust the cost of goods sold for that depreciation expense. So I'm going to do two pieces here. So without any other information, the best guess we will have to assume, and again, it's not always a perfect assumption, but it is the best we have, that the change in the accumulated depreciation account is basically reflective of the depreciation expense. Remember, the depreciation expense journal entry is depreciation expense is debited for some number Y, and accumulated depreciation is credited some number Y. Okay, so if we know that the beginning balance is $1,200, and we know that is a credit balance, and we know the ending balance is $1,450. Well, then that Y that makes this balance must be $250. All right, so I can change that Y to a $250. So that $250 is my depreciation expense number. Okay. If I'm going to take that out then of my cost of goods sold, I can just subtract that out of there. And so that would be $2,540, which would be my depreciation, which would be cost of goods sold without depreciation expense. Okay, and I will need that number for the direct method. All right, so let's go ahead and tally these up on our little sheet here. Sorry. So we know that depreciation expense, or our best guess of the depreciation expense, is $250. And that's going to be in the indirect method. And for cost of goods sold, adjusted for the depreciation expense, help me out here, was that, let me look back, forgot that already, 2,540. All right. I got to flip back here, 2,540. All right. What else do we know? We know that accrued expenses are included in SG&A. Okay, that's nothing we're going to need for the indirect method, but it is something we'll need to go for the direct method, and we'll solve that a little bit later. Accounts payable relates entirely to the purchases of inventory. That's an assumption we're going to make for the direct method, which in this class we're always going to make, and we're also going to always make the assumption that accounts receivable relates entirely to the sales of customers. So that's one more assumption we're always going to make in this class. All right. So with that, I think we've got the adjustments just about right, and I can start preparing my statement of cash flows. Let's do it in 3 sections. So the first section is the operating section, and I'm going to do this a little bit quickly, not worry about format too much, just so we can get through this. We always start with net income, and in this case, it is 1,410. I am going to add back the depreciation expense, which I just calculated a little bit ago, and that is a $250 adjustment. I am then going to look at all the changes in my assets account. Primarily, remember, operating is short-term assets and short-term liabilities. And on the asset side, it's always beginning minus ending, and that's real small there. But on the liability side, it's ending minus beginning. And if we do this formula, it'll always give us the right sign. So if I just start right down the list and look at accounts receivable, I do my beginning minus ending, so my 1,500 minus my 2,200, that's going to give me a negative 700. I'm then going to look at inventory, which is another short-term asset, and that's 1,800 minus 2,900, and that's a negative 1,100. The next is fixed assets, which is a long-term asset, which we're not going to worry about here. So I'm going to jump down then to my liability side. I'm going to look at accounts payable. And again, I'm looking now at ending minus beginning. So 3,500 minus 1,000 is a 2,500 positive number. Accrued expenses, and that's a 1,700 minus a 1,400. That's a 300. Yeah, I think my math is right. And I think that the next one is bonds, and bonds are always long-term. So if I do this subtotal then, that should give me cash flow from operations, cash from ops. And that number is $2,660. All right, so that's my cash from operations. Next, we're going to look at the investing section. And if we think about our investing section, that was what? Long-term assets. And if we look at our long-term assets, we have two. We have the fixed assets, which there's no change from beginning to end. We have the accumulated depreciation, which we've already taken into account above with depreciation expense. And we got land. And you can see that if we, again, following the short-term assets, beginning minus end, 800 minus 300, that's a 500. So that would be a sale of land because the land account decreased. So that would provide a source of cash. Okay. And so cash from investing is $500. Okay. And I'm going to put a little box on these so I can pick out my totals quickly. Right. And we have one last piece then we're going to look at, and that's cash from the financing section. Put a little line here to keep me straight. We'll look at the financing section. And in the financing section, again, we are looking at, so this was short-term assets and liabilities, investing was long-term assets, and financing is long-term liabilities and equity. And what we see then is I can skip my asset section and go right down to, I have some bonds. And again, if I follow my formula of ending minus beginning, it's 2,900 minus 600. So there must be $2,300 adjustment in sale of bonds. So I sold a whole bunch of bonds and collected a whole bunch of cash. My common stock has not changed. My preferred stock account has not changed, but my treasury stock has. So again, let's follow the formula, ending minus beginning. And let me get right treasury stock here. So if we do ending minus beginning, so a negative 500 minus a 0, that number is a negative 500. Okay, so we are going to have a negative number for our treasury stock. And then the last piece we have to pick in, if you remember, we picked in the dividends. Again, we don't specifically look at the retained earnings account because it's typically the adjustments for the retained earnings is taken into account in net income. But to the extent we have dividends, we have to pick that up. And if you remember, we had $6,200 in dividends paid. So cash used in financing, and I believe that total is a negative 4,400. So if I add up the sum of all my cashes, right, and all my cash from the boxes, so the 2,600, the 500, and the 4,400. So my total change in cash is a negative 1,240. My beginning cash from my balance sheet was 1,300. And if I add those two together, I think I get $60. And that should equal my ending cash. And it does. And so my statement of cash flows, indirect method, all balances. All right? So that is the statement of cash flows for slip-on in sandals, the indirect method.